So, does war in Israel mean a big market meltdown? It's hard to escape the news of war in Israel, isn't it? The brutal attacks by Hamas terrorists on Saturday, October 7th were just the latest in a seemingly endless series of threats to Israel's security. It's not unusual for investors to not only wonder about global security, but also about possible impacts on global markets in times of war. And we have two notable ones currently: the ongoing conflict between Ukraine and Russia, and now this latest war between Israel, Hamas, and potentially others in the Middle East. For some context, Israel is a relatively small country at 8,355 square miles. It's smaller than the state of Massachusetts. Total population is about 9.2 million, making it only the 98th largest country in the world, just over 1/10 of global population. Israel has been a successful market economy with a GDP that is 1/4% of global GDP and about the same percent of global market capitalization. Still relatively small, but in the last decade, Israel has emerged as a high-tech leader. Since its modern establishment in 1947, the Israeli Defense Force, or IDF, has made 10 official declarations of war and engaged in 6 other major conflicts. Counting this most recent war starting 2 weeks ago, there have been 12 wars or conflicts since 1973, and only one defeat on that list, and that occurred in the Security Zone campaign in Lebanon, where the Israeli army was ultimately forced to withdraw from Lebanon. This means that in the 76 years modern Israel has existed, it has been at war in at least 35 of them, pretty much half the time. The Arab-Israeli conflict goes back thousands of years historically, and while relations with some of its neighbors have improved recently, there are many who still would rather Israel just did not exist. So one way to think about the future is by looking at the past for similar circumstances. Unfortunately, when it comes to wars and conflicts involving Israel, we have more data points than anyone wants. In wondering what impact there might be on stock markets, we decided to look at the average calendar year returns of foreign stock markets and the U.S. stock market during the first calendar year of an Israeli war or conflict. Then we looked at all years when there was a war or conflict indirectly or directly involving Israel, and then all years from 1973 to 2022. Now, we excluded 2008 from the calculations because while the Great Financial Crisis did correspond with the first year of an Israel war, it seems clear that the GFC was not caused by a Middle East conflict, and it was such an outlier. People are often surprised at the seeming lack of impact that a global political crisis like a localized war can have on global stock market returns, especially over longer-term periods. In the case of wars involving Israel, history would say that on average, stock market returns both inside and outside the U.S. show little discernible difference from peacetime. Foreign stocks across all 49 calendar years since 1973 had an average return of 11.5%. If you look only at years where Israel was in a war or conflict, the average return actually increases to 11.9%. The opposite is true for U.S. stocks, which had average returns of 12.8% across the entire period, and only an 11.9% return during Israel's war and conflict years. When looking at the calendar year in which the conflict began, average returns are a bit lower, just above 9%. But as stock market returns go, those are still in line with long-term averages. So investors considering whether to take an investment action based on events or circumstances like these can understandably feel the pressure to take action, to do something. We feel more at risk when we see a war unfolding. Unfortunately, for long-term investing, this is more often than not a detrimental impulse. We feel as though this kind of war must have a negative impact on our portfolios, but the data would say that that is actually a lower probability and certainly not something that is knowable in advance. Uncertainty is always the condition of the world, and when a war breaks out, we simply see a confirmation of that underlying unpredictability. Joe Wiggins reminds us to stop and ask how influential the event, in this case, the war in Israel, is likely to be as it relates to meeting our objectives. For an investor, the most important thing is to have our portfolios constructed based on our goals and making them resilient in light of many potential risks. If the past has any information about it regarding the future, the likely conclusion to be made is that this war will have relatively little impact on meeting our long-term objectives, at least as it relates to our investments. Doesn't mean we don't care or should ignore it, especially if we're considering travel. But our impulses and actions in these circumstances are usually better expressed outside of our investment decision-making. Thanks so much for joining us today. While the world is always full of difficulties, it is also filled with people who want to solve problems and encourage progress. We agree with David Booth that one of the best antidotes to the many fears that can come with an uncertain future is to become an educated optimist. At Foster Group, we do our best to provide timely, factual information, and at the same time to be an optimistic voice in a media world where those can be hard to find. We hope you join us next time for another educational and optimistic edition of Financial Perspectives.